Why does your portfolio change without you touching it? Who benefits when it does? And what does the institution know that it will never tell you? Financial psychology has a name for all three answers. And it is costing UK investors money every quarter, automatically, silently, without a single decision. Of course, this will be done in a friendly and warm way, even if the subject matter seems a little daunting. You will at least be informed by the end. One mechanism, one annual action, 30 minutes a year. That is the difference between the portfolio you set up and the portfolio you actually hold. If you have not subscribed, that is also status quo bias. The exact mechanism this episode is about to explain. Just saying. Did you know the investment you set up and forgot is now working against you? It was designed to do exactly that. Not by accident, by a system that profits from your inaction and has no interest in telling you the allocation has changed. Portfolio drift is not a failure of discipline. It is a feature of how markets work, and a feature of how financial platforms are built. Every episode in Series 4 names one psychological mechanism that costs investors money without their knowledge. This is the second one. The first, familiarity bias, is in Episode 18. The mechanism. A portfolio allocated 60% to equities and 40% to bonds does not stay at 60-40. Markets move every trading day, equities and bonds move at different rates. Without a deliberate correction, the allocation shifts, continuously, silently, in the direction of whichever asset class has grown faster. This is what financial psychology calls default drift. The FCA Consumer Duty, introduced in July 2003, explicitly requires firms to monitor whether retail customers are achieving the outcomes they need from their products, including investment products. The regulator introduced this requirement because the evidence showed investors were not reviewing and correcting their allocations. The drift was real, the regulator named it. The platform notification still does not exist. For most of those investors, the portfolio that was drifting was not a self-managed ISA. It was a default workplace pension set up by their employer, allocated at enrollment, never reviewed, drifting silently for years while markets moved. Not chosen. Defaulted. Then abandoned. Think of it like a monopoly board where one player has quietly bought all the orange properties while everyone else was focused on Mayfair. Nobody changed the rules. The board just drifted. As an illustrative example using USD price returns, the S&P 500 returned approximately 29% in 2019, approximately 16% in 2021. UK investors holding in pounds saw different returns due to currency movements, but the direction sustained equity outperformance over bonds held across all measures. A 60-40 portfolio drifted significantly toward equities. Without a single decision, every institutional investor I worked alongside for 31 years rebalanced their portfolio on a fixed schedule. Not when they felt like it, not when markets moved dramatically. On a schedule, quarterly for most. Annual minimum. The schedule was not a preference. It was a governance requirement. The portfolio had to match the mandate. Default drift was not tolerated. The retail investor has no such governance requirement. No mandate, no board. No quarterly review committee. The retail investor has whatever frequency of review they personally remember to perform. The data, confirmed by the FCA Consumer Duty review process introduced in 2023, shows that frequency is, for a significant proportion of UK retail investors, 0 times per year. The institution rebalances because it must. The retail investor rebalances when they remember. Most do not remember. I set up my portfolio in Series 1. I thought carefully about the allocation, 60% equities, 40% bonds. I have not rebalanced once since then. The equities ran hard in the years after I set it up, which means, right now, my portfolio is significantly more equity heavy than 60%. I did not choose that, I just did not notice it happening. That is default drift. What Kai is describing is portfolio drift. It is not a mistake, it is a mathematical inevitability. The mistake is not that it happened, the mistake is that there was no system to catch it. The institution has that system. The retail investor does not. Well, not necessarily, because there is a 2023 rule that begins to change this completely. But first, Source Card 1. The FCA Consumer Duty July 2023 confirms portfolio drift is a live unresolved problem in UK retail investing. A 60-40 portfolio in a sustained equity bull market drifts toward approximately 70-30, without a single investor decision. The risk profile increases silently. The investor believes they hold a balanced portfolio. The market has made it an equity-heavy one. Source Card 2. The asymmetric risk. When equity markets correct, as they did in 2022, when the S&P 500 fell approximately 19%, a portfolio that had drifted equity-heavy lost significantly more than the 60-40 the investor believed they held. The drift changed the maximum loss in a downturn. Silently, without a decision. Source: S&P 500 Annual Return Data, 2022. Public market record. The fun fact, status quo bias was first documented not in a financial study, but in a 1988 study of how voters chose between incumbent and new political candidates. Samuelson and Zeckhauser found that the same mechanism keeping politicians in power also keeps your portfolio allocation frozen. The mechanism has a name. It is not a character flaw. It is a documented cognitive pattern. The question was, did you know the investment you set up and forgot is now working against you? The answer is yes, if you have not rebalanced. Financial psychology calls the mechanism status quo bias. The brain treats inaction as neutral. It is not, and default drift is what happens when status quo bias meets a portfolio that nobody is watching. Every month it continues. The portfolio diverges further from the allocation you chose. Status quo bias does not feel like inaction. It feels like a decision, the decision not to change something that seems to be working. The portfolio is still there. The app shows a positive number. Nothing has gone wrong in a visible way. The bias is precisely calibrated to feel like wisdom. It is the mechanism working precisely as designed. The wrong belief. Once you build a portfolio with the right allocation, it stays at that allocation unless you actively change it. The portfolio is stable by default. Inaction preserves the design. Market returns shift portfolio weights continuously. A 60-40 portfolio drifts to approximately 70-30 in a sustained bull market without the investor touching it. The drift does not announce itself. The platform does not flag it. The allocation the investor set is not the allocation they hold. Status quo bias, identified by Samuelson and Zeckhauser in the Journal of Risk and Uncertainty in 1988. The human brain treats the current state as a neutral reference point. Changing it requires effort. Not changing it requires nothing. The brain rewards inaction with the feeling that nothing has gone wrong. That feeling is default drift in operation. So each year I did not rebalance, and I never rebalanced. I was not doing nothing. I was making a decision. The decision was to let the allocation drift. I just did not know I was making it. Default drift. It had a name the whole time. True story, back in 2009 when I was running a retail investment desk, I watched this exact thing happen. A client came in after the financial crisis. Their portfolio had drifted from 60-40 to 78-22 equities during the bull run of 2003 to 2007. Nobody had flagged it. The platform had collected its quarterly management fee throughout. When the correction came in 2008, they lost substantially more than their stated risk profile implied they should. The platform sent a letter expressing sympathy. In my experience of institutional investment management, the platforms that serve retail investors have no structural incentive to alert the investor when their portfolio has drifted. A notification saying the allocation has changed would generate a review. A review may generate a switch to a lower-cost fund. That sequence produces less revenue, not more. The notification does not exist because it does not benefit the platform. And, I should say this clearly, there is a YouTube channel that profits when you watch content about this, including this one. The difference is that this channel has no ongoing management fee attached to your inaction. The FCA Consumer Duty, introduced in July 2002-30, requires firms to act to deliver good outcomes for retail customers, including monitoring whether customers are getting the outcomes they need. The drift problem exists. The regulator has named it. Well done. You just made it onto a regulatory watch list. Now take a look at how many platforms have actually changed their notification system since July 2003. The system collects its ongoing charge whether the portfolio is at 60-40 or 70-30 every quarter. Automatically, the drift does not reduce the fee. The drift does not trigger a review. The system was designed around the investor who does not notice. Not for them. Source 1. FCA Consumer Duty. July 2023. Firms are required to monitor whether retail customers are achieving the outcomes they need from their products. The drift problem is named. The fix is mandated. Full link in the description. Source 2. Samuelson and Zeckhauser, Journal of Risk and Uncertainty, 1988. Status quo bias, the human brain treats the current state as a neutral reference point. Changing it requires effort. Not changing it requires nothing. The brain rewards inaction with the feeling that nothing has gone wrong. That feeling is default drift in operation. Here's the actual lesson, and here's the 2023 rule Marcus mentioned. The FCA Consumer Duty now requires platforms to demonstrate good outcomes for retail customers. That means the legal pressure to notify you about default drift exists. The platform's commercial incentive not to does too. The countermove is not to wait for the platform. It is to install the same system the institution uses. One scheduled review per year, one action on that date. The rest of the year, nothing. One approach many investors use. One calendar reminder, once per year, on the same date. On that date, open the portfolio, check the current allocation, compare it to the original target, sell what has grown beyond the target, buy what has fallen below it, close the platform. That is the entire annual review, under 30 minutes. Commit now. Set the reminder this Saturday. The annual calendar removes the decision from the equation. The decision is not whether to rebalance. The decision is made once in the calendar and then executed on the scheduled date. Status quo bias needs a choice to exploit. The calendar removes the choice. This is a Tier 1 counter move. Remove the decision entirely. Status quo bias interacts with the familiarity trap, which episode 18 named. The drifted allocation feels familiar. The new, heavier equity portfolio has been there for months. It no longer looks wrong. That familiarity is the second mechanism reinforcing the inaction. The calendar removes both. The date arrives, the review happens. Neither bias gets a vote. Calendar, set, annual rebalance, same date every year. I am not going to remember to do this on my own. The last few years prove that. The calendar removes the need to remember. That is the point. Default drift stops when the system runs instead of the memory. Concentration fixed. Episode 18. Default drift fixed this episode. Calendar set. The portfolio is now the portfolio I designed. But there is a third problem I have not looked at yet. The thing that is supposed to protect me when equity markets fall. Did you know the bonds in your portfolio lost money the same year your equities did? Subscribe. See you next week for episode 20, where Nadia investigates why the thing designed to protect you did the opposite. New episodes every week. Right. My portfolio drifted without my permission, so I set a calendar reminder to rebalance. The reminder fired this morning. I opened the app to confirm the reminder. While I was there, I checked the portfolio. It had drifted further. I set another reminder. Comments. Marcus wants to read them this week. The subscribe button is there. It puts the next mechanism in your notifications before the system gets another quarter out of you. Think of one person, a colleague, a friend, a neighbor, who mentioned their pension, their ISA, or their savings in the last year. Send it to them before Friday. That is the only ask. If the 60-40 to 70-30 drift surprised you, the like is the signal. 1 second, it tells the algorithm to find the next person who needs this. 2 episodes that explain what this one builds on. Episode 18. Why your portfolio was already overweight one market before it started drifting. Episode 4. Why you sold at the worst moment. Same system, different mechanism. Pick the one that sounds like your situation. See you next week for episode 20, where Nadia investigates why the thing designed to protect your portfolio did the opposite. Default drift stopped the moment the calendar was set. The platform charged its fee either way.